Money Talks. I'm Greg Vogel, Portfolio Manager at GKV Capital Management. The S&P 500 is now down this year more than 23%. It's fair to ask, how bad can things continue to get? High inflation and slower consumer demand are expected to slow economic growth, maybe even push us into a recession. We've talked before about the importance of expectations for the economy and expectations for earnings, which drive stock prices. With slower growth comes lower earnings, making stocks look more expensive, despite this year's declines. The price of a stock is underpinned by cash flows. Companies are created and operate to sell goods and services. Ideally, those goods and services are sold at a price that enables the company to operate at a profit. The owners of the company, the stockholders, can choose to pocket those profits as dividends or reinvest to grow the business and capture more market share, or frequently do a little bit of both. The positive cash flows, the profits, are what differentiates a stock from speculating in gold or Bitcoin or work of art. Companies generate earnings and payments in the future, and they'll always be worth something today. I'll gladly pay you $100 today if I can reliably expect to receive payments of $20 a year from you for, say, the next 20 years. Buying Bitcoin, I'm speculating that in the future, others will be willing to pay more than what I paid for it today. A stock works differently. I'm betting that the future earnings of the company will grow, making the value of the stock greater. It's the value of the future earnings that makes the stock rise in value. So earnings provide a compelling floor for the value of a company. A company that earns $5 a share is not likely to ever see a stock price anywhere near $5. To return to the earlier example, my paying you $100 in exchange for 20 years of $20 payments is a good deal. It implies a nearly 20% annual return. Even better for me would be paying $50 for the same payments, a nearly 40% annual return. Future cash flows, future payments, have a mathematically determinable value. The part that becomes subjective, the part that makes investing in stocks tricky, is the speculation and opinions around how much those future payments will really be. Take electric cars, for example. It's apparent that electric cars are the future of the automobile industry. Leading companies in the industry should thrive. And, well, Tesla is the current leader. If I am convinced that Tesla will dominate sales of electric cars for the next 10 years with dominant market share, then I should estimate very large future profits as I extrapolate continued success into the future. In 2024, analysts estimate nearly $20 per share in earnings from Tesla. Total revenues expected to more than double to $140 billion. Tesla could achieve these numbers. The company might even exceed them, or it might not. Competition is growing. Producing cars in volume is difficult. Teslas sell at a premium, resulting in industry-leading profit margins. But if there is a recession or economic growth simply slows, maybe growth in the number of buyers slows, maybe Tesla's 15% operating margins will decline with competitive pressure. The problem here is that there are a lot of unknown future variables. If you told me for sure what Tesla was going to earn in 5 or even better 10 years from now, I could tell you with certainty whether the stock is cheap or expensive at today's $650 per share, which is now 50% lower than the high only 6 months ago. My point here is not whether Tesla is a worthy investment or not at current levels. Rather, greater uncertainty of future earnings results in volatile swings as investors place bets on whether the current outlook for future earnings is too optimistic or pessimistic. Extrapolate our example across the entire market. Are we going into a recession or not? Well, the outlook's uncertain. Most of the economic data we have is backward-looking. Retail sales last month slowed a little bit, but they're at all-time highs. So are corporate profit margins, but that was last month. We all know inflation is high, and consumers may have to reduce spending on all kinds of goods and services to put gas in the car and food on the table. Unemployment was a low 3.6% last month. People that want jobs have jobs for the most part. That's great for the economy and consumer spending, but if sales growth slows, companies will slow hiring. Help wanted signs can be replaced with pink slips. Again, unemployment is a lagging indicator. It tells us that times last month were great. It doesn't tell us a whole lot about economic fortunes next year. Interest rates are rising rapidly in the face of inflation. Higher rates will have a slowing impact on the economy. No one knows just yet how much economic growth will slow. That uncertainty is forcing a reevaluation of what stocks are worth. And the more speculative the stock, the less certain the future cash flows, the greater the reevaluation. When the economic outlook is positive, investors are willing to assume the best projections. As the outlook changes, visions of evaporating earnings and big losses take over. If we chart the performance of the S&P 500 over the last 20 years, the annual return is about 6.5%. Over the last 3 years, the return has been faster, nearly 9%. We threw a lot of fuel on the fire to push the economy through the pandemic. All that stimulus drove the economy the last few years, but we now have to contend with higher inflation and lower growth. Maybe we should expect a return to more normalized market returns of 6.5% for a while. But first we have to find equilibrium. What should the right expectations for growth really be? Until we have more visibility into the future earnings outlook, stocks will remain volatile. Each new data point is carefully examined as a possible positive or negative indicator of what the future might bring. We have raised significant cash in our portfolios. The companies we continue to own are the larger industry leaders that are likely to hold up better in an economic downturn. With rising interest rates, bonds are beginning to look more attractive than they have in the last 5 years. We expect to allocate more to fixed income if inflation can be managed. Rising mortgage rates, now near 6%, will likely lead to a pullback in real estate returns after years of significant gains. It's too early to recommit cash to either stocks or bonds just yet, but once earnings are adjusted, once they reflect a realistic economic outlook, we can start buying again selectively. Earnings will keep stocks from falling too far, but negative sentiment for the economic outlook can still get more negative. It is possible that stocks have lower to go before we can resume long-term gains, much as they did in 2001 and 2008. Don't be in too big a hurry to buy the dip. For more detail on our analysis, you can download our quarterly update from our website at gkvcapital.com. You can also sign up for our email distribution list to receive our reports in your inbox. Thank you very much for watching.